I would say that Russia will be quite happy, or has been quite happy, to put the ruble on a gold standard. And it's very much in her interest, because the moment she puts it on a gold standard, gold would just flood into Russia because of
Yeah.
her interest rates. It's the interest rate differential. What we've seen Comex do to reserves in London, a Russian gold standard would do to the rest of the world, sucking in
Yeah.
gold from everywhere.
Alasdair Macleod, good afternoon to you, or good evening to you. How are you, my friend?
I'm very well. Nice to be with you.
It's great to have you on. As I mentioned to you just briefly off camera, you're the one guy that I've been really looking forward to. I've spoken to so many people, but this is my first time speaking with you, so I'm looking forward to a great, enlightening talk. Let's start with the gold market, which is really up your wheelhouse. That is what you do. What is going on? It's so strange and so strong. And just give me a 10,000-foot view of what you know, and then I'll start asking some questions.
Okay. Well, it's the two aspects of this. The one is the general background, I think, and the other is what has been happening in markets over the last sort of couple of months. The big overall picture is that gold is legal money and everything else is credit. What is happening is it's not gold going up, but it's credit going down. So when you see the People's Bank of China buying gold, actually what they're doing is they're selling dollars. So they're getting out of credit and going into money. And that basically is what's happening. Now, the vast majority of people actually don't understand this, but it has always been the history of detached credit that when it starts losing purchasing power, the last people to really understand that it's not prices going up, but the purchasing power of that currency going down, because currency is credit. Then, when they finally realize that, the currency is doomed. It's just finished. So, talk to people in Venezuela, for example, or Zimbabwe or whatever. They have experienced that. And so have the grandparents of some of the Germans I talked to. So, that is the key thing to understand. That's the big overall picture. There's something we can also add to that, and that is that we are in the biggest credit bubble in history. Very few people realize this. We sort of think our stocks are going up. That's fine. Okay. Some stocks you buy on momentum, some you buy on value, but, we're used to doing this. There's nothing extraordinary. So people are not aware that this is actually the biggest bubble in history. Now, the reason I say it is the biggest bubble in history is that we've had a series of bubbles since the financialization of Western economies back in the mid-1980s. And those bubbles have never, ever been allowed to work themselves out. There has always been the intervention to stop them working themselves out. So the result is that you have got an accumulation of bad debts in the zombie companies, in the banking system, in the derivative system. You've got all this credit which has never had the washout, which sort of allows you to start from point one again. The destructive creation that Schumpeter described, that's not been allowed to happen since 1985. This time, it's all rolled up into this final bubble. When this one breaks, it'll probably take everything with it.
God.
What we're looking at is, for example, if you look at the equity markets, once they start descending into a bear market, that will become unstoppable. You're then talking about the collateral for the banking system. We've already got the collateral being undermined in commercial property. What they call commercial real estate in America, is going to happen in equities as well. And it'll also happen in bonds, because what happens when you see credit risk in bonds? Well, the answer is that the yields rise. Now, this is counterintuitive, if you like, in current thinking. everybody thinks that the Fed has got control over interest rates and therefore bond yields. No, they haven't. I mean, they can probably whip the interest rates down to zero, but they'll crash the currency if they do it. So they don't actually have control over the outcome. They've now got this problem. If they want to actually stop this credit bubble from bursting, then they're going to have to trash the currency. So what happens to the currency? What happens to the foreign ownership of the currency? Well, the answer is that foreigners are not going to hold a currency which is going down the tubes unless they get an interest compensation to compensate them for all the risk. So you can see that the Fed is now in this, they're damned if they do and they're damned if they don't. Now we have a situation where, okay, we've got the credit bubble and, credit bubbles can be sustained and all the rest of it. But along comes President Trump with his tariff, the most beautiful word. You've got a combination of the credit bubble and Smoot-Hawley Tariff Act number 2. What does that remind you of? It reminds you of 1929 to 1932. And what happened in 1931, 32? Over 5,000, 8,000, I don't know what the number is, banks went bust. The reason money supply contracted is not, as the Keynesians say, because. It's because basically the banks went bust. So, we actually face this situation. So, coming back to gold is real money. Everything else is credit. Where is the risk? It's in credit. Get out of credit, get into gold. So that's the basic drive, if you like, of the relationship between gold and credit in the form of dollars or euros or yen or sterling or whatever. It's the credit going down. So that's the big picture. Now, short term, we've had an interesting situation. The bullion banks, the swaps, if you like, bullion bank traders who are in the swaps category on Comex, have been short. And if you look at their outstanding positions, the gross positions were worth roughly a short position of about $80 trillion between, 25 traders, something like that, 25, 26 traders. Now, we've obviously got to the point where they're getting rather worried. And I can just imagine, bank treasurers coming along to the trading desk and saying, look, you're demanding more and more credit on your trading account. What the hell's going on? I've already allocated $3 trillion to you for your gold and for your silver. What is going on? When am I going to get this position closed down? So you can see the pressure is going to be on the dealers as it rises. And not only that, but the dealers will, they don't understand anything about economics. Okay, we know that. But then look at the chart and they'll think, God, this chart looks too good. And we're short. Shit. So you can see that there is pressure, if you like, from that side for them to try and scramble to close their positions. So what this led to, and you could say that there's all this story about tariffs against gold and all the rest of it, which is a load of hogwash, actually. But you could see that it might have been a contributing factor to some people thinking, this is just getting too difficult. We've got to close down our positions. Now, if you're short on Comex, then what do? Somebody comes along and wants to buy a contract. If you're going to duck it, you're going to raise your price. It's as simple as that. And that is how you ended up with this enormous premium to the spot market, which, of course, created the arbitrage for anywhere where there was any sort of, liquid gold, as it were, as opposed to paper, to flood in to just strip out that sort of $50 or whatever the premium was. It was, money for a rope. So that was one problem. Now, there is another problem, which very few people have mentioned. And, the LBMA did a video on this, with all their analysts, top analysts and all the rest of it. And they didn't even mention this. And that is the stand for deliveries on Comex. Because I've been tracking these since 2021. And I have to say that since 2021, around about the middle of that year, when I started taking up the numbers, until the end of last year, 2024, over 2,000 tons had been stood for delivery of gold. That is a hell of a lot of gold. On top of that, since January the 1st, the rate at which the stands for delivery have been increasing has been at roughly 4 times last year's rate. If the current rate of stand for deliveries continues since January the 1st, then the total for this year will be over 2,000 tons. This year alone, much as the previous 4 years put together. Okay? Now, we have to understand what the stands for delivery are. I mean, basically, you'd think this is being delivered out of the market to somewhere. No. What happens is that it's noted, if you like, that you are now, in theory, the owner of however much gold you've stood for delivery. But actually what you tend to get is a piece of paper, a confirmation. Yeah. Because remember, we're dealing with a credit market. These guys don't like the hard stuff. They just like pieces of paper.
Yeah.
And it was just coincidental that there was a wonderful piece on Garter, which was covered by Garter, of this guy who was working as a dealer for Sprott. And they stood for delivery for some silver. And something that was meant to take 5 days took 9 months. 9 months of prevarication, obfuscation, every excuse under the book. Oh, and can we have the, serial numbers for the bars? Never got it. It was recounted that, they took legal advice on this. And the lawyers said, forget it. Now, the reason given, I don't think is actually the real reason. If you actually took these guys to court, you would never deal in the futures market again. That would be my view. Yep. They're a cartel. It's as simple as that. But who's standing for delivery? Well, we don't know. But I think a pretty good guess is it's dealers through the Globex facility, which is the global facility, Globex. It's what it says on the tin. And, they don't have this sort of relationship with the market where, Goldman Sachs or JP Morgan says, you do this trick on us again and we'll cut you out of the market. They couldn't give a shit. As far as they're concerned, they just want their gold. So you can see that the pressure to actually deliver out of Comex is mounting and mounting and mounting. So it was actually quite important that there was a flow of gold from other centers like London, Switzerland, even Delhi, or Mumbai or whatever, into Comex. So you've had this sort of, stuff all going in. It's basically all spoken for. And when it goes out, I don't think it's going to go back into, say, liquidity in London, Switzerland, whatever. So I think this is liquidity that's gone out of the market. So the situation in a market sense, I think, is being set up for yet another bear squeeze. To give an example of how the bear squeeze has progressed so far, earlier this month, we had a period where open interest on Comex fell from just under 600,000 contracts, 597,000, something like that. Fell all the way back down by 75,000 contracts. At the same time, the price rose over $200. Now that is a bear squeeze. I mean, it's quite simple. And who are the bears? The establishment is the bears. In other words, there was a run on the establishment, if you like. So that's basically the background. Now, it's something that has eased. The premiums have now gone and all the rest of it. The open interest has come down. So things are slightly, if you like, slightly less uncomfortable. Let's put it that way for the shorts. So they're back in the game. And what we saw today was, no news. I mean, we know that the global economy is declining. I mean, it really is. Forget GDP figures. Those are all boosted by government spending, which is unproductive, et cetera, et cetera. We all know that economies are tanking. Now, of course, the hope is that the Fed is going to cut interest rates. So, that rescues us. And of course, if the Fed's going to cut interest rates, that takes pressure away from the funding and all the rest of it and all the crisis and so on and so forth. So we can bang the price of gold. We can bang the price of silver. So that's all that's happened today. It's, anyone who trades it, in my view, has either got to be very, very smart, have a good track record of trading, getting this right, which, let's face it, very few of us have. Or alternatively, the best thing to do is to just keep stacking, because what are you doing? You're getting out of credit, getting into real money, which is gold. So that, if you like, is the big overview and also the market view.
Got it. Well, there's a lot of directions I could go in with this, but the first thing I'd like to ask, if you could take a step back about 10 minutes. You say that this all started in the mid 80s. What was the event that started all of this in the mid 80s, in 1985 specifically?
Yeah. Well, we always have credit bubbles. There's a cycle of credit expansion and contraction. This is something that happens. It's driven by bank credit more than anything else. And this the Austrian economists call the business cycle, but actually it's driven by a cycle of credit expansion and contraction. And if you go back, you'll see that this is a regular cycle, which takes approximately 10 years on average, sometimes a bit longer, sometimes a bit shorter. So when we financialized the banking system, in other words, the banking system, instead of lending to commercial entities, began dealing in stocks, dealing in this, dealing in that, not just dealing in credit, but dealing in credit, credit squared and all the rest of it, and the invention of derivatives and all this sort of stuff. Then this actually led to an even less stable environment, which meant that central banks, and particularly the Fed, Bank of England, and latterly the ECB, had to develop the skills of stopping these credit bubbles from actually popping. And, so all you get, if you like, is a slowdown as the interest rates are cut. Interest rates are cut right back. Yep. If it's done sort of skillfully enough, then, the banks don't start foreclosing on everybody and all the rest of it. And they just, sort of quietly let their balance sheets sort themselves out. Instead of being highly leveraged, let's say sort of 15 times assets to equity, it sort of falls back, all helped by inflation, incidentally. But in other words, the expansion of central bank credit, as it were. Mm-hmm. So that falls back to somewhere, let's say, less than 10 times. Then you're off to the races again. So it's a cycle. And we haven't had a real crisis. We had the great financial crisis, which to my mind is a misnomer because I know what's coming. The great financial crisis, what did the Fed do? The Fed, opened its checkbook and said, look, don't go bust. Here is as much credit as you need at almost zero cost, yours. So that way, what happened was that, okay, it was slightly unpleasant. We had a halving, if you like, of equities measured by the S&P. You had property on the market, residential property on the market for nothing for a year or so. And then everything went back to normal. In other words, nobody went bust. A few did. Obviously Lehman went bust. They were allowed to go bust, and they'd like just that one bank to go under, and that one bank created so much chaos in the whole system. Yeah, it could have brought down the whole system, actually. So the Fed had to work even harder, if you like, to deal with the consequences of their decision to, somehow inject some morality into their management of a situation. These guys, these bankers can't rely on us bailing them out. Okay, so we'll nearly brought down the whole thing. They even rescued one of the big insurance companies. I can't. Was it? I can't. That's the one. Yeah. because they were creating, they took the view that the derivative was just like an insurance contract. So they were creating these things, out of thin air, which, wonderful business, but, it all came unstuck. But anyway, so that was all rescued. But what happened? Nobody really went bust. And what's happened to all the unproductive debt in the system? It's just grown and grown and grown. And it's also grown in terms of government debt. And government debt to GDP is now horrendous. I mean, it really is. And if you look at the US situation in particular, I mean, currently they reckon debt to GDP is about 125%. I don't know, something like that. Depends what your view is on GDP, and it depends on, what you include in the debt. But, all you need is a decline in the GDP, and you will find that ratio suddenly is going through the roof. But the private sector is already contracting. I mean, basically, to work that one out, you've got the US budget deficit is running at the rate of about 6.5% of GDP. Take that out of nominal GDP, which, according to the CBO, is growing at around about 4.5%, if you believe it, which means that 6.5 minus 4.5 means that the private sector is actually contracting by 2%. Now, this is the productive, meant to be the productive, and it's not that productive, let's face it, because of all the zombie companies and all the rest of it. This is the productive side of the economy upon which the state relies for its taxes. You can see how this budget deficit is going to get worse as the economy tanks. And it's not just America, it's everywhere else. This is the worst possible time to have supply chain disruption, extra tariffs, and all the rest of it. All these things are all going to happen as a result of Trump's beautiful word, tariffs. So, the combination of the biggest credit bubble in history, plus Smoot-Hawley Mark II, I think is just toxic, horrendous. So, do you want to be in credit? I don't.
Right. So game this out for me, if you would. So let's say we are contracting, and let's say that accelerates. The Fed starts cutting, everybody starts cutting drastically. Then what? Then gold goes to the moon, things still contract, or do we reset? Is that when we reset?
Well, this idea of a reset sort of presupposes that the government can, somehow get control of the situation. Government has no control over the situation whatsoever. So dismiss that view entirely. If there is a reset, it'll be done by the markets, in effect.
Right.
Yeah, I mean, there was a phrase you used in terms of the Fed's policies. I mean, the Fed actually, I think, has got a hell of a problem with this. It really does. Because if you have increased risk in credit, then the interest rate has to rise. It's as simple as that. On the other hand, to have interest rates rising when the economy is definitely suffering, the private sector, I mean, forget the government side, private sector is definitely suffering, is obviously adds to the burdens of the private sector. So, what does the Fed do? Does it go against the tendency for interest rates to rise and suppresses them? Or does it just stand back and let everybody sort out their own arrangements? I mean, the Fed does not have a mandate to just stand back. I think it's only got one policy course, and that is to try and manage not so much the inflation side, but the other side of the mandate, the unemployment bit, by reducing interest rates. Which raises the question, well, what is inflation? Inflation, I think, is a complete misnomer for the situation. Really, what we're talking about is a fall in the purchasing power of the currency. And when you understand that, you take away this idea that rising prices is linked to the quantity of money, expand the quantity of money, and rising prices go up. No, what we're looking at is naked credit without any conversion into real money. which is losing purchasing power. Why? Because it is increasingly risky. So, you can easily have a collapse in the purchasing power of the currency while the economy is tanking. And indeed, I would say that those are the conditions which tend to exist at the same time. Conventional macroeconomic thinking is you can't have what was named stagflation, back in the 70s. You can't have this combination of a stagnating economy or contracting economy and rising inflation, because they just link it to the quantity of money, which is completely wrong.
Yeah.
I mean, a lot of the time it's right. Other things being equal, that wonderful phrase economists use. But when you get a situation where you're going to get substantial bad debts, then it's different.
Yeah.
It's interesting because, sorry, go on. Yeah.
You go ahead.
It's interesting because today we've seen a significant fall in the yield on the 10-year US Treasuries.
Right.
And, when you read the commentary, it's all about, we think that with the soft economy and, blah, 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 that the Fed is going to cut rates by 50 basis points in this year. No, so the yield comes down. I mean, this is a complete nonsense, because what's happening is that the Fed is, if it follows that course, and I really think it's got no alternative, then effectively it is undermining the value of the dollar measured in goods and services. So, what does that do to interest rates? I mean, you're dependent on foreigners in America for funding government debt, whatever. I mean, there's something like 32 trillion of foreign-owned dollars and financial investments in the US. And we're not even talking about, Euro bonds and all the rest of it. And we're not even talking about all the dollars tied up in foreign exchange transactions, which, I mean, according to the Bank of International Settlements, is a further $82 trillion.
Yeah.
We're talking huge numbers here. So anyway, 32 trillion, which the US Treasury has identified in terms of bank balances, short-term investments, long-term bonds, in other words, bonds with a maturity of more than 1 year, and equities. Equities, I think, was something like 14 to 15 trillion. They're going to sell. So what does that do? This is the problem. They're going to sell when they see a bear market in equities. Okay, so that hits the dollar, not necessarily against other currencies. That's a different story, but against real money, which is gold. So, how do you stop that? Well, the only answer is that interest rates have got to rise. Dollar rates have got to rise. And that's already against a background of an economy which is tanking. So, you can see the dilemma that the Fed is going to face in 2025. I mean, I think it's absolutely clear.
Yeah. It's hard to see an economy growing at all when interest rates are rising under the current circumstances.
Well, yeah, I mean, but the thing that's got us to this point actually is that, there's so many zombie companies. I mean, the productive use of capital in the private sector has got to be at an all-time low, while the amount of credit is an all-time high. I mean, it's a fascinating situation. Look at Russia. Now, everybody says Russia's, terrible financial condition and all the rest of it. Okay, I'll just give you some numbers which make it absolutely fascinating. Russia has inflation running at something like 8 to 10%. Okay. Its interest rates are around about 20%. I haven't looked at it the last month or so, but around about 20%. Now, what the banks are doing is they're offering deposit rates of 20 or percent, 19, 20%.
Yeah.
Okay. Now, people are saving. Why are they saving? Because the economy is doing so well that people's wages have been rising something like 20 to 40%. Depending on what they're doing. Okay. And what these guys are doing is they're saving. The inflation's only 10% tops. And okay, there are lots and lots of widows. You can the Western press can interview coming out of the supermarkets in Moscow, say, "Oh, the price of butter is terrible," and all this sort of stuff. But actually, it's a fascinating situation. And do you know what the rate of tax is in Russia?
I have no idea.
Well, I will tell you, it's 13% flat. Now, if you're a very high earner, it's 15%. Yeah. Now, okay, this is a wonderful situation, and it's come about because Russia is the largest exporter of energy, oil, gas, and all the rest of it. Okay, things might have changed a little bit, and do you know what the government debt to GDP is? Less than 20%.
Yeah.
Well, this is the economy which Western economists will tell you is in a straits.
Right.
I mean, it's absolute crap. If you look at if you look at our economy and you see how precarious we are, the numbers are very, very different. I mean, taxation is through the roof.
Right.
We've got debt is through the roof. We're all whistling to try and keep our courage up.
Good.
And where's the economy going? It's going in a completely opposite direction from Russia's. So, and Russia has the technology to produce these hypersonic missiles, which are so fast that nothing we have in the West can possibly down them. I mean, it's just amazing. They have things which go at Mach 5. This is unbelievable. And not only that, but they have mobile missiles. In other words, ones which can be launched off the back of a truck, which travel at Mach 3. We've got nothing that catches that. And when it hits the ground, it obliterates everything down to about 600 feet or something like that. I mean, it's just absolutely staggering. They have the technology which we would dream of on our defense capability. But we're not told this. We're not told this.
No.
Shh, keep quiet.
Right. Let me ask you if we can pivot a little bit back to gold. This rise in gold price, which has been really, really surprising, but not surprising if that makes sense. It's the expectation I have always had, but then when it's happening, I've been like, oh my gosh, is this it? Is it?
Yeah.
Really, my question is this due to, is it the arbitrage? Is this due to just there's no gold in the exchanges for people that want to take delivery? So that's jacking up the price? Is it central bank buying, or is it all of the above? What exactly is it?
Well, it's all of the above, basically. I mean, the central banks have been buying for some time. The Asians have been buying for some time. And really, liquidity in Western capital markets has been reduced right down. On top of that, of course, the way in which Western capital markets work is they have become a lot more efficient in terms of the use of credit relative to the amount of bullion that they need to hold to back up the mountain of credit. So, this generally develops into an accident waiting to happen. And this is why I think the stands for delivery, or stand for deliveries on Comex are actually an important part.
Yeah.
What's happening. I mean, you will see, you can see a chart of how, Comex warehouse stocks have risen. They've risen very sharply recently. They've gone back up pretty much to the levels that we saw in 2020 when we had the last panic. After 2020, when the panic subsided, the stuff started running out of the warehouses. So where did it go? Don't know, really.
Right.
Some of it might have gone back to London. I don't know. But stocks went way down. They'll go way down again. But I think that what we're looking at is gold which is going out of the system. And the replenishment, of course, is mine supply. Who are the two largest miners? China, Russia.
Right.
Australia is pretty big too. I mean, it's sort of more or less level pegging with Russia, but Russia is taking, I think, taking over the number 2 slot. Wow. Anything else out of the Asian continent, places like Kazakhstan and so on and so forth, I think goes straight back in, if not in Kazakhstan, to neighboring countries. the amount of free gold available to the West actually is not all that great.
Yeah.
And you've got central banks are still buying. I mean, central banks, they sort of instinctively understand the risk in credit, which is why they're increasing the quantity of gold in their reserves. What they're doing is they're increasing the quantity of real money and decreasing the quantity of fake money. In other words, currencies. That's all they're doing, and this is the basis of the whole argument. The difference between real money, which in common law is gold. I mean, it's silver, but silver's not priced as money anymore. And currencies, which are just purely credit.
Yeah.
Depend on the fact in the issuer.
Do you see that slowing down at all, central bank buying, or do you see that only accelerating?
I see no reason for it to slow down. I can see every reason why it would accelerate, because as I think more and more people understand the risk is in credit, not in a high gold price, then under those circumstances, I think you're just going to get more and more buyers for the available physical stock, which basically is not coming our way. I mean, a lot of it is already spoken. And I'm sure, I mean, we don't know who's standing for delivery on Comex. As I say, I suspect it's Globex dealing. I wouldn't be surprised if central banks are using this as a source, because where else can they go? I mean, did they go to London? There isn't the liquidity there. Do they go to somewhere like the refiners? The refiners will say, well, join the queue. Might get something to you in the next 6 months, which is not good enough. So if you actually want some fiscal bullion, I mean, I'm talking about a ton or two, you really got to go to Comex. Retail market is, there's lots and lots of liquidity in the retail market. I mean, we're talking about big volume where typically people buy less than $100,000 worth of gold at a time. But, if you're talking about a ton or two, then, really, you've got nowhere else to go other than stand for delivery on Comex.
Yeah. Well, I guess what's the end game here then is, like, with central banks buying gold, are they see it like, I guess what I'm trying to say, are they trying to restructure their economies around gold then? Or is that what is happening? Or is it just out of just sheer what they see happening coming in the future, which is just a lot of destruction of credit?
Yeah. Well, I think they see they see the latter. They see the destruction of credit. It's interesting. I would say that Russia will be quite happy, or has been quite happy, to put the ruble on a gold standard, and it's very much in her interest, because the moment she puts it on a gold standard, I mean, gold would just flood into Russia because of her interest rates. It's the interest rate differential. What we've seen Comex do to reserves in London, a Russian gold standard would do to the rest of the world, sucking in gold from everywhere, where the yield on gold is less than, say, 15%. So it would allow the Russians to reduce their interest rates quite significantly, because they would manage the gold reserves. They wouldn't try and use interest rates to manage the economy. That's the key. So I think they've been in a position where this really would work. And this, I think, was behind their attempt to get a gold-backed currency on the BRICS agenda ahead of the Johannesburg meeting in 2023. So, but that was ruled out by India in particular, who, A, hadn't gotten enough gold themselves, and B, they're basically Keynesians. And they've been educated by the Bank of England in how to manage their affairs, if you like. So, and the other thing is that China takes a view that she lets everybody else make mistakes. She doesn't want to be accused, if you like, of destabilizing the Western financial system, which I think is sensible and makes, is completely understandable. So I think where China is, China has very substantial hidden reserves. I reckon that that's probably over 30,000 tons. I think also that if you look at the withdrawals from the Shanghai Gold Exchange vaulting system, the people in terms of jewelry and small bars and coin and so on have got around about another 26,000 tons.
Gosh, that's a lot of gold.
Oh, it is. But I mean, a lot of people too. I mean,
Yeah, true.
it's so there's that. And I think the other thing is, which we did see, is the amount of gold owned by banks and so on and so forth, which is still within the SGE vaults. The reason for this is that most banks will offer a gold account as well as a current account, particularly with the reduction in interest rates in China. It makes having a gold account a lot more attractive for households.
Yeah.
Now, the reason I mentioned households is that household savings are 35% of GDP. 35%. So we're looking at $2 to $3 trillion every year,
Right.
needing to find a home. Now, in the past, it went into unoccupied property.
Yeah.
That bubble has gone. You've got you've got the stock market, and that's had a very checkered history as far as households are concerned. The only other thing you have is bank deposits, and the banks have tried to enhance the return in order to attract these funds, or keep them on their balance sheets by giving them special rates. As long as you locked up for 3 years or something like that. So that's the way in which they've done it. But the reduction in interest rates in China recently has made that unattractive. So consequently, I think more and more funds are going into these bank gold accounts. Now, the banks don't actually have the gold, if you like, in their own vaults, because the way the Shanghai Gold Exchange works is that anything that's taken out of their vaults is then scrapped going back in. So you leave it in the vault. That's what happens. So I think they're huge quantities of gold owned by the banks to back their gold liabilities to households sitting there. So, I mean, the amount of gold over there is just simply unimaginable. And it explains why there is such a shortage of the real stuff in the West, particularly when, we reckon that the way in which you gain exposure to gold is you go and buy an ETF, or you can buy a mine or whatever. And in any event, it's so unfashionable. We'd rather have in a video. So there's we're not in the same game. We really are not.
Yeah. So I guess I'll leave this. This is my last question, and is how does this really end? Is it just a shifting of power, economic power from the West to the East, if you would? Is that how this is the end game? Or, what's your thesis on?
Yeah, that's basically what's happening. And it's already changed a lot more than people realize. This is the whole point about BRICS and the Shanghai Cooperation Organization. China now exports more to the BRICS than she does to America.
Wow.
So we think that America is, China is dependent on America. Well, yeah, to a degree, but not as much as anybody thinks. She's been deliberately moving away from being so tied to the US economy. It's a deliberate act of policy. So, that's already happening. Now, what we're talking about is 70% of the world population in BRICS, and maybe there are more who would like to join BRICS and all the rest of it. Why? Because China invests. I mean, she's got capital, and she will go to somewhere in Africa and say, we can build a railway for you, or we can build, a decent harbor for you and put in decent facilities so that we can ship your cobalt out, or whatever it might be. I mean, an area which I know from my childhood was, East Africa. We built a railway back in, I think it was just before the First World War, which was known as the Lunatic Express. And this was meter gauge, and it went from Mombasa up to Kampala in Uganda. And I used to go down to the coast with my family for holidays on this thing, and it was lovely. but we're going back a while. Well, the Chinese have now put in a proper railway, and that's going all the way right into the Congo. I mean, Kampala is just a stop on this line, and so all this, all the sort of valuable commodities and all the rest of it are all available to China. What it's doing for the African continent is absolutely staggering. It's opening it up.
Yeah.
Now, there are social problems with the whole thing because I don't think that the Chinese I don't think they integrate well. They like to keep control of what they're doing and all the rest of it.
Yeah.
The employment opportunities for Africans are probably not all that great in the sense that the Chinese will ship in their own citizens basically to run these things. But they are at least doing it on a joint venture basis locally. Yeah.
Yeah.
Now, what do?
Colonize.
I mean, Doge is finding out. I mean, they've now stopped it, which, good for them. Basically, you get dollars, printed by the Fed, and you sort of chuck them over and bribe the politicians in Africa to stay on side.
Yeah.
We're doing constructively nothing. Okay, we'll military base there.
Yeah. Right.
So
right.
you can see that. I mean, I can tell you that, particularly in Africa, the whole of the sort of political scene has evolved. It's evolved from turning its back on colonialism. It's gone through a period of, corruption and all the rest of it. I mean, Nigeria was a prime example. Where did all its oil money go? Into the pockets of the guys running the country and all the rest. They're coming out of that. And Africans, I mean, it's not clean yet, but they are a lot more responsible. They are taking a more nationalist view for their country's benefit rather than their own personal benefit. And consequently, they are embracing the inward capital from China, the joint ventures and all the rest of it, and the development that's coming with it. And this is why Africa is growing at something, GDP, which I don't really rate as a measure of anything. But, if you look at how GDP is growing, I mean, it's just sort of 8, 9, 10% or something. Admittedly from a low base, but you can see the potential. This is an industrialization, which is, if you like, similar to what this country, Britain, went through in the 19th century. It basically took people out of poverty. And this is now happening for the majority of the world's population who are prepared to sign up to that joint hegemony of China and Russia and away from America. And, along comes President Trump, who basically wants to withdraw from the rest of the world. What a gift to China and Russia. I mean, and to us, incidentally, because as we fail in the West, there is another parallel world out which is going to continue and will probably end up rescuing us indirectly, not directly, but indirectly. So fascinating times. Yeah.
No, it really is. I think we'll end on that, Alasdair. If people want to do business with you, find out more about you, how do they go about doing that?
Well, I run a Substack, and the objective basically is to educate people who obviously want to be educated, people who are beginning to sort of discover what their governments are doing, where it is all going wrong. So I talk about economics, and particularly in the context of money and credit and the relationship and understanding what money and credit really are. And obviously, with gold being legal money since Roman times, still legal money, explaining what's going on in the precious metals markets and getting a feel for the whole thing, because it's all about protecting yourself for the future. We're not talking about increasing wealth. We're talking about protecting wealth now. And I think that's the important thing. So my Substack, basically, which you'll find alasdairmacleod.substack.com, or just Google Macleod Finance. It'll take you there.
Excellent. I'll put all of this in the show notes below on the YouTube channel, as well as the Apple podcast, as well as the Spotify podcast. Alasdair, big fan. I finally get to talk to you. I'm very, very grateful. Thank you so much for your time.
Well, thank you very much indeed for having me on.
Take care.